Hi, welcome to this quarterly market update, where we're going to unpack what's been happening in the investment markets over the course of the second quarter of 2023. Unlike recent previous quarters, this time we haven't had to wrestle with urgent shocks in the LDI market or the threat of a banking crisis. But the quarter has kept us on our toes as central banks have dug in their bid to tackle ingrained inflation, along with political events such as the now almost familiar threat of a US debt ceiling undermining US treasuries, and the potential for a military coup in Russia. I'm joined today by Tom Pawelski, Senior Consultant in our Birmingham office, and Tom's going to get us started with what's been happening to UK interest rates.
Thanks, Simeon. So inflation remained stubbornly high in the UK over the second quarter and stayed at 8.7% in May, the same as it was in April. Inflation was expected to start falling once the April 22 energy price cap rise fell out of the calculation period, but this hasn't proved to be the case. The Bank of England raised the bank rate twice in Q2, by 0.25% in May and 0.5% in June, to a 15-year high of 5%. The market now expects that interest rates will peak in this cycle at 6.25% in 2024, but will also need to stay higher for longer than previously hoped in order to bring inflation back down to the 2% target.
Whilst the inflationary environment has to date been something of a global phenomenon, the picture is now settling out to be something more of a unique issue for the UK. In the US, 12-month CPI inflation has fallen for 11 months in a row, now from a high of 9.1% down to 4%, leading the Federal Reserve to decide not to increase interest rates at its last meeting. The ECB in Europe has been clear on the need for interest rate rises, given it's keen to avoid the wage price spiral that's been experienced in the UK. Overall inflation in the Eurozone fell to 5.5% in May, a fall that was greater than expected. However, there's a disparity of inflation levels, with Spain now at less than 2%, whilst Germany close to 7%. This demonstrates the difficulty of managing different countries with one interest rate. Tom, can you take us through what's been happening with sterling?
It's been an interesting period in currency markets, and the pound was up 5% against the dollar in the first half of the year. Much of this is due to the market's anticipation of more aggressive monetary policy being needed to control inflation in the UK than in other countries. In all, currency hedged investors will have experienced favourable returns over unhedged investors over this strong period for sterling. Some have argued that the rally in sterling may actually be short-lived, with currency holders over the long term favouring economies where interest rates are high due to strong underlying economic growth, over those where interest rates are high simply in response to out-of-control inflation. The IMF actually improved its growth forecast for the UK over the quarter, and having previously predicted the UK to fall into recession, the revised forecast estimates the UK will grow in 2023 and 2024.
Corporate bond credit spreads tightened overall, albeit they edged up towards the end of the quarter. In late June, Thames Water announced the CEO would be stepping down as the business faced the potential for renationalisation, following issues with the magnitude of its debt, which many pension schemes would hold in their investment-grade portfolios. We'll now take a look at the returns across the different asset classes.
Global equities fared quite well over the second quarter, especially for currency-hedged investors, buoyed by a stronger pound. UK equities finished Q2 marginally down, hindered by contractionary monetary policy, and also exposure to the oil sector, where wholesale prices have fallen. Emerging market equities also posted negative returns for currency-hedged investors. In credit markets, the tightening in spreads wasn't enough to offset the impact of rising interest rates, and so corporate bonds also posted negative returns. Long-dated real and nominal yields were up significantly in April and May, and dipped slightly in June. With inflation expectations falling slightly, aggregate UK DB pension scheme funding on a low-risk basis was up significantly over the 3-month period, and this was despite more mixed returns from most growth asset classes. This sits in contrast to many pension scheme members who will have actually seen the value of their benefits eroded by higher inflation, which has for some time now exceeded typical caps to benefit increases.
On to the outlook now. Our market views have remained similar to last quarter, with our views on direct lending, long lease property and diversified alternatives remaining favourable. We've moved our view on developed equity to neutral for positive, and this reflects our view that whilst corporate earnings remain resilient, positive overall returns over the quarter have reduced the upside as we see it. We maintain our favourable view on equity protection, with the cost of protection having fallen over the quarter. Risk transfer is also looking attractive. Do you want to talk us through that?
So many pension schemes will be better funded than expected thanks to rising gilt yields over the last 2 years, and they're now considering how they can secure these improvements through risk transfer. The most popular option being bulk annuities, or buy-ins and buy-outs as they're more commonly known. Transaction volume in the bulk annuity market is expected to top £50 billion this year and to grow further next year and beyond.
Towards the end of June, the Parliamentary Work and Pensions Committee released a detailed report setting out a number of recommendations following its investigation of the LDI market in light of the gilts crisis last September. Its focus is on regulatory changes, but there are a number of recommendations that could have significant implications for trustees. In particular, it's likely to delay the new funding and investment regime, which was previously targeted to come in April 2024. So that concludes our update for this quarter. For more information, you can visit our website, but otherwise it just leaves me to say thank you for joining us.